Welcome to Trader's Book Insights. Today, we're diving into Burton G. Malkiel's A Random Walk Down Wall Street to unlock its game-changing lessons. Imagine mastering the idea that short-term stock movements are essentially random. That's what this deep dive is all about. We'll be exploring practical takeaways you can use right away.
It's a powerful concept that challenges conventional wisdom and can really shift your perspective on investing.
Okay, let's unpack this. The book starts by contrasting two fundamental theories of how stocks are valued. Firm foundation versus castles in the air. What's the difference?
The firm foundation theory argues that a stock's price should be tied to its intrinsic value. Things like its earnings, assets, dividends, the company's real, tangible worth. This is the classic fundamental analysis approach.
Makes sense, but castles in the air sounds way more exciting and maybe a little precarious.
Right. Castles in the air suggest that stock prices are often driven by speculation and investor psychology, more than by cold, hard fundamentals. Think hype, trends, even fear and greed playing a role.
So less about balance sheets and more about what's trending on Twitter.
In a way, yes. And Malkiel uses some vivid historical examples to illustrate this point. Have you heard of tulip mania?
Vaguely. It involves tulips, right? Some kind of crazy bubble.
Exactly. Back in the 1630s in Holland, a virus infected tulip bulbs, creating these beautiful, unusual patterns. Suddenly, everyone wanted these bizarre tulips.
A virus creating fashion trends for flowers. That's wild.
It gets wilder. People started trading these bulbs like they were gold. Prices skyrocketed, and speculation ran rampant. At the peak, some single bulbs were worth more than houses.
Wait, you're telling me people were mortgaging their homes for a flower? What happened next?
Well, like all bubbles, it eventually burst. Prices crashed, fortunes were lost, and people were left holding tulips that were suddenly worth a fraction of what they paid.
Ouch. So what's the takeaway for us centuries later? Are we all susceptible to tulip mania in different forms?
Absolutely. Tulip mania is a classic example of how investor psychology and FOMO, that fear of missing out, can drive prices far beyond rational levels. We see similar patterns today with meme stocks, cryptocurrencies, and even in the housing market.
It's a reminder that even in today's high-tech, data-driven world, markets are still influenced by human emotions and biases. Okay, so tulip mania is one example. What other castles in the air does Malkiel highlight?
He talks about the South Sea Bubble in 18th century England. Investors went crazy for a company claiming to have exclusive trade rights with South America. It was hyped as the next big thing. Problem was, the company barely even existed. Pure speculation.
So a company with a great story, but no substance. A familiar tale even today.
Right. And then, of course, there's the 1929 U.S. stock market crash. Rampant speculation, fueled by buying on margin, essentially borrowing money to buy stocks, led to a massive bubble and a devastating crash.
I'm guessing buying on margin amplified both the gains and the losses.
Exactly. It's like adding fuel to the speculative fire. These stories might seem like ancient history, but Malkiel's point is that these patterns repeat themselves. The assets might change from tulips to internet stocks, but the underlying human behavior remains the same.
So are we doomed to keep repeating these mistakes? Are we all destined to fall for these castles in the air?
Not necessarily. By understanding these patterns, we can learn to recognize the signs of speculation and make more rational investment decisions.
That's a bit reassuring. But how do we differentiate between a genuine investment opportunity and a speculative bubble waiting to burst?
That's where things get tricky. It's not always easy to tell in the moment. But Malkiel argues that by focusing on a company's underlying fundamentals and avoiding get-rich-quick schemes, we can reduce our risk of getting caught in the next bubble.
Solid advice. It's easy to get swept up in the excitement, but it's crucial to stay grounded and focused on the long term. Okay, so we've seen how castles in the air can lead to these booms and busts, but where does the random walk part come into play?
Malkiel introduces the concept of the efficient market hypothesis, or EMH. This idea suggests that stock prices already reflect all publicly available information.
So the market is basically a giant information processing machine, constantly absorbing news, data, and even rumors.
That's the idea. And because of this efficiency, It's incredibly difficult to consistently beat the market by trying to predict which stocks will go up or down.
So all those hot stock tips and fancy algorithms are basically a waste of time.
Not necessarily worthless, but the EMH suggests that it's very hard to consistently outperform the market over the long term. And this is where Malkiel's argument for index funds comes in.
Right. Index funds. Those are like the low maintenance, set it and forget it option of investing. But how do they actually work?
An index fund aims to replicate the performance of a specific market index, like the S&P 500. It does this by holding the same stocks in the same proportions as the index itself.
So instead of trying to pick individual winners, you're basically buying a slice of the entire market.
Exactly. And this offers several advantages. Index funds are highly diversified, meaning they spread your risk across hundreds or even thousands of stocks.
That makes sense. Don't put all your eggs in one basket.
Right. Plus, index funds typically have very low fees compared to actively managed funds,
Yeah.
where a fund manager is trying to pick stocks. And over the long term, those fees can really eat into your returns.
So if markets are efficient and unpredictable, why bother with all the hassle and expense of trying to pick individual stocks? Just buy the whole market through an index fund and let it ride.
That's Malkiel's core argument, but as you might expect, there are critics of the efficient market hypothesis. Some point to the existence of successful investors like Warren Buffett, who seem to have consistently beaten the market. Others highlight market anomalies and bubbles as evidence that markets aren't always perfectly rational.
Okay, so it's not as simple as just buy index funds and forget about it.
It's rarely that simple in the world of investing. Malkiel acknowledges these critiques, but he still believes that for the vast majority of investors, index funds offer a sensible and effective way to participate in the stock market.
So it's not about completely abandoning stock picking, but more about having a solid foundation of index funds, and then perhaps adding a sprinkle of individual stocks if you're feeling adventurous.
That's one way to approach it, and this is where understanding the nuances of the efficient market hypothesis and its limitations becomes really important.
Well, it seems like a random walk down Wall Street has already given us plenty to think about. We've covered historical bubbles, the efficient market hypothesis, and the basics of index funds.
And we've only just scratched the surface. There's so much more to explore in this book.
That's exciting.
Yeah.
Where should we go next in our deep dive?
Next, let's delve into Malkiel's fascinating analysis of the conglomerate craze of the 1960s. Another example of how speculation and creative accounting can inflate stock prices. We'll see how even seemingly solid growth companies can be built on shaky foundations.
Sounds like another cautionary tale, but one with valuable lessons for today's investors. I'm ready to learn more.
You know, it's fascinating how these patterns of speculation and market psychology keep recurring throughout history. The 1960s conglomerate craze is a perfect example.
Okay, take me back to the swinging 60s. What was the conglomerate craze all about?
It was the era of growth stocks. Companies were merging across completely different industries, creating these giant conglomerates. The idea was that these mergers would lead to explosive earnings growth and, of course, soaring stock prices.
Sounds like the corporate version of bigger is always better.
Right.
But was there real value behind these mergers? Or was it just hype?
That's the key question. Malkiel argues that many of these conglomerates were more focused on manipulating their earnings per share, EPS, than on creating genuine synergy between the businesses they acquired.
Okay, hold on. Let's break that down a bit. What exactly is EPS, and why is it so important?
EPS stands for earnings per share. It's basically a company's net income divided by the number of outstanding shares of its stock. Investors use EPS as a key metric to gauge a company's profitability and growth potential.
So the higher the EPS, the better, right?
Yeah.
At least from an investor's perspective.
Generally speaking, yes, but here's the catch. Companies can manipulate their EPS through various accounting maneuvers, and that's what many conglomerates were doing in the 1960s.
Okay, I'm intrigued. How are they pulling that off?
Imagine a hypothetical company called Synergon. Let's say Synergon has earnings of $10 million and 10 million shares outstanding, giving it an EPS of $1. Now, Synergon decides to acquire another company, let's call it WidgetCo, that has earnings of $5 million and 5 million shares outstanding, also resulting in an EPS of $1.
So both companies have the same EPS, but Synergon is twice the size of WidgetCo.
Right. Now, after the merger, Synergon's total earnings will be $15 million, and it will have 15 million shares outstanding. Simple math tells us that its new EPS will still be $1.
Okay, so the merger didn't actually increase Synergon's EPS.
Exactly. But here's where the accounting magic comes in. By structuring the merger as a stock swap, where Synergon issues new shares to acquire Wigico, they can create the illusion of earnings growth.
I'm starting to see how this could get tricky.
The market sees that Synergon's total earnings have increased to $15 million, and its stock price might go up based on that. But the underlying reality is that the merger didn't actually improve the company's profitability on a per-share basis.
So it's all about perception versus reality. The conglomerate craze was driven by this obsession with EPS growth, even if that growth was artificial.
Exactly. And this ties back to the castles in the air idea we discussed earlier. The focus was on short-term stock price gains fueled by hype, not on building companies with solid long-term value.
And what happened when investors realized that the emperor had no clothes?
Well, just like with the tulip bubble and the South Sea bubble, the conglomerate bubble eventually burst. Many of these conglomerates struggled to manage their sprawling empires, and their earnings growth faltered, stock prices tumbled, and investors who had bought into the hype were left holding the bag.
It's a reminder that even in the seemingly sophisticated world of finance, there's no substitute for understanding a company's true value and not getting swept up in the latest trend.
Absolutely. And it brings us to another period of market excess, the dot-com bubble of the late 1990s. This was a time when the castles in the air theory was on full display.
Ah, the dot-com bubble.
Yeah.
Feels like a cautionary tale that's still relevant today. What were some of the key factors that drove this bubble?
The internet was exploding in popularity, and investors were pouring money into any company with a .com at the end of its name. Valuations skyrocketed, often based on little more than a compelling story and the promise of future growth.
It was like the Wild West of investing, everyone rushing to stake their claim in this new digital frontier.
And just like in the gold rush, there were few genuine nuggets of gold, but a lot of fool's gold as well. Traditional valuation metrics like the price-to-earnings ratio, PE ratio, were thrown out the window.
Hold on. Explain the PE ratio for those of us who aren't finance whizzes.
The PE ratio compares a company's stock price to its earnings per share. It's a measure of how much investors are willing to pay for each dollar of earnings. A high PE ratio can indicate that investors are very optimistic about a company's future growth prospects.
So during the dot-com bubble, companies with little or no earnings were still getting sky-high valuations.
Exactly. Investors were betting on future potential, not on current profitability. And in some cases, that bet paid off handsomely. But in many others, it led to massive losses when the bubble burst.
What were some of the red flags that investors might have missed during the dot-com frenzy?
One red flag was the reliance on new and untested valuation metrics. Since many internet companies had no earnings, investors started using metrics like price-to-sales ratio, PS ratio, which compares a company's market capitalization to its revenue.
So instead of looking at profits, they were looking at revenue, even if that revenue wasn't translating into actual earnings.
Right. The problem was that this metric didn't take into account profitability or the sustainability of that revenue growth. Another red flag was the role of security analysts, who were often issuing buy recommendations on companies with inflated valuations.
Were they just caught up in the hype, or were there other factors at play?
Malkiel suggests that conflicts of interest might have played a role. Some analysts worked for investment banks that were underwriting the IPOs of these dot-com companies. So there was an incentive to promote these stocks, even if they had doubts about their long-term viability.
So it's a reminder to always consider the source of investment advice and to be wary of potential biases. What about the role of the media? Did they play a part in inflating the dot-com bubble?
Absolutely. The financial media was hyping the internet boom, creating this culture of day trading and get-rich-quick schemes. Stories about teenagers becoming millionaires overnight fueled the frenzy and encouraged reckless speculation.
It sounds like a recipe for disaster.
And it was. When the dot-com bubble burst in the early 2000s, many internet companies went bankrupt, and investors lost trillions of dollars. The NASDAQ index, which was heavily weighted toward technology stocks, plummeted by almost 80% from its peak.
It's a stark reminder that even in the age of the internet, market bubbles can still form and burst with devastating consequences.
And it reinforces Malkiel's point that investors need to be aware of the dangers of speculation and to approach investing with a healthy dose of skepticism.
So we've journeyed from tulips to conglomerates to dot-coms. What's the common thread running through these historical examples?
The common thread is the powerful influence of investor psychology. Fear, greed, and the herd mentality. When these emotions take over, markets can become detached from reality, leading to bubbles that eventually burst.
And what about the random walk theory in all of this? Does it hold up in the face of these seemingly predictable booms and busts?
That's a great question, and one that continues to be debated. While the efficient market hypothesis suggests that predicting these events is extremely difficult, Malkiel acknowledges that markets aren't always perfectly rational.
So it's not a black and white issue. There's room for both efficient markets and behavioral biases.
That's one way to think about it. And that's what makes investing so challenging and ultimately so fascinating.
Well, a random walk down Wall Street has certainly given us plenty to chew on. We've explored historical bubbles, the efficient market hypothesis, the power of index funds, and the dangers of speculation.
And there's still more to uncover. Next, let's dive into another compelling example of a market bubble, the U.S. housing bubble and crash of the early 2000s. We'll see how even seemingly safe assets, like real estate, can get caught up in speculative frenzy.
Sounds like a cautionary tale for our times. I'm ready to dive in. The U.S. housing bubble and crash. It's still fresh in many people's minds. What can we learn from this relatively recent example of a market bubble?
It's a fascinating case study because it wasn't driven by some exotic asset like tulips or internet startups. This time it was real estate, something people considered safe and stable.
Safe as houses.
Right.
That's what everyone used to say.
Exactly. But as we've seen throughout history, any asset class can become susceptible to speculation and bubble formation. In the early 2000s. A confluence of factors created the perfect storm in the housing market.
What were some of those key ingredients?
Government policies aimed at promoting homeownership, for one. These policies encouraged lenders to relax their lending standards, making it easier for people to get mortgages, even if they were subprime borrowers with poor credit histories.
So more people had access to mortgages, leading to increased demand for houses. That sounds like a recipe for rising prices.
Precisely. And as prices started to rise, it created a self-fulfilling prophecy. People saw their neighbors making money by flipping houses, and they didn't want to miss out, so they jumped into the market, further driving up prices.
Classic FOMO, just like we saw with the tulips and the dot-coms.
Exactly. And then you had the rise of complex financial instruments like mortgage-backed securities, which bundled thousands of mortgages together and sold them to investors.
Right.
These securities were seen as relatively safe, even though many of the underlying mortgages were subprime.
So it was like a house of cards built on risky mortgages, but disguised as a safe investment.
That's a good analogy. And when those subprime mortgages started to default, the whole system began to crumble. The mortgage-backed securities lost value, banks and financial institutions suffered huge losses, and the housing bubble burst.
It's amazing how interconnected the financial system is. A problem in one area, like subprime mortgages, can ripple through the entire economy.
That's one of the key lessons from the 2008 financial crisis. It highlighted the systemic risks that can arise when speculation runs rampant and financial innovation outpaces regulation.
So back to Malkiel's random walk theory. Does this housing bubble and crash challenge the efficient market hypothesis? After all, if the market is truly efficient, shouldn't it have recognized the risks and prevented this from happening?
That's a fair question. Events like the 2008 crisis do raise doubts about the absolute efficiency of markets. However, Malkiel would argue that even though markets can be irrational in the short term, over the long term, they tend to self-correct.
So it's not that the efficient market hypothesis is wrong. It's just that it doesn't always capture the full complexity of human behavior and the occasional bouts of irrationality.
That's one way to think about it. And this is where behavioral finance comes in.
Okay.
Behavioral finance explores the psychological factors that influence investors' decisions and how those factors can lead to market anomalies and inefficiencies.
So it's not just about numbers and data. It's about understanding the human element of investing.
Exactly. And this is why Malkiel, despite being a strong advocate for efficient markets, also emphasizes the importance of minimizing trading costs and avoiding emotional decision-making.
It's about staying disciplined and sticking to a long-term investment strategy, even when the market gets crazy.
Right. And speaking of staying disciplined, Malkiel offers some valuable insights on the role of professional investment advice. He's quite skeptical about the ability of most active fund managers to consistently beat the market.
I've heard that most actively managed funds actually underperform simple index funds over the long term.
That's what the data suggests. And Malkiel attributes this underperformance to the fees and trading costs associated with active management. These costs can eat into returns, making it harder to outperform a low-cost index fund.
So it's not just about picking the right stocks. It's also about minimizing expenses.
Exactly. And this brings us to one of Malkiel's most important pieces of advice. Don't try to time the market. He argues that it's extremely difficult, even for professionals to consistently predict when the market will go up or down.
I imagine that trying to time the market can be emotionally draining as well.
Absolutely. It can lead to impulsive decisions and missed opportunities. Instead, Malkiel advocates for a buy and hold approach, where you invest in a diversified portfolio of stocks and hold them for the long term, writing out the market's ups and downs.
It sounds like a much calmer and more rational way to approach investing.
It certainly is, and it aligns with his belief in the power of compounding returns. Over time, even small gains can snowball into significant wealth if you're patient and disciplined.
So if we accept that markets are largely efficient and unpredictable, does that mean we should just give up on trying to pick individual stocks and stick solely to index funds?
That's a question Malkiel wants you to wrestle with. He presents a compelling case for efficient markets and the challenges of stock picking. But he also acknowledges that there may be temporary inefficiencies that create opportunities for those willing to do the research and take on the risk.
It's a balancing act then, weighing the evidence for efficient markets against the allure of finding undervalued opportunities.
Precisely. And this brings us to one of Malkiel's more intriguing concepts, the paradox of investment advice.
Okay.
He argues that if a piece of investment advice is truly valuable and you act on it, you'll likely profit. But if that same advice reaches many people and they all rush to follow it, the very act of following it eliminates its usefulness.
So it's like a self-defeating prophecy. The more people who act on good advice, the less effective it becomes.
Exactly. And this paradox underscores the importance of independent thinking and critical analysis. Don't blindly follow the herd, even if it seems like everyone else is getting rich.
It's a reminder to do your own research, to understand the underlying fundamentals, and to make investment decisions that align with your own risk tolerance and financial goals.
That's a great summary. And ultimately, I think that's what makes A Random Walk Down Wall Street so valuable. It encourages us to think critically about our investment strategies, to question conventional wisdom, and to approach investing with a healthy dose of skepticism and a long-term perspective.
Well, Burton Malkiel has certainly given us a lot to ponder. A Random Walk Down Wall Street is a must-read for anyone who wants to understand the complexities of the financial markets and make informed investment decisions.
It's a book that challenges your assumptions, expands your knowledge, and empowers you to become a more confident and successful investor.
Well said. And on that note, we'll wrap up our deep dive into this insightful and thought-provoking book.
Remember, the journey of investing is a lifelong pursuit. Keep learning, keep questioning, and never stop exploring new ideas.
Join us next time as we delve into another influential trading book and uncover its game-changing lessons. Until then, happy investing.